third of the size of the market leaders, leaving a path for expansion into a wallet where we see a $100 billion addressable opportunity. And in security services, we gained approximately 240 basis points of wallet share since 2022 and closed a $1 billion gap to our closest competitor. So as you can see on the page, services has met or exceeded all Investor Day targets for revenue, ROTCE, and market share. You know, I get asked a lot of questions about the performance of our services business during periods of macroeconomic challenges and low interest rate environments. On this slide, I wanted to illustrate how services is a through-the-cycle business and give you a historical view of how we performed over the last decade. And if I can ask you to take one word away from this slide, that would be resiliency. Our resiliency is a result of our commitment to our footprint, our suite of products across our 5 interconnected businesses, our strategy to support clients through uncertainty, and lastly, and very importantly, continuous innovation. On the top right-hand side of the slide, you can see what this resiliency means for our business. We are deeply embedded in our clients' operations, and this results in long-standing relationships with sticky global deposits, recurring transactional flows, and embedded FX. This all contributes to the consistent performance we've seen across our core fee drivers, including scalability over the last few years, and therefore gives us the confidence to continue to deliver going forward. And on the left side of this slide, you can see our track record of delivering consistently over the last 10 years. During this period, even in times of recessionary environments, with interest rates close to zero, the business still delivered ROTCE in the mid to high teens. And as you can see, since 2016, we've doubled the size of our business. While we've benefited from higher rates, our outperformance was also driven by balanced growth across our entire business. Revenue, given all these technological advances, will be a critical area of focus for all of us across the industry to simplify and to improve. Given all these dynamics that you see on the slide, I believe our strategy, summarized on the right side, is well positioned for the future, centered on 3 focus areas. First, executing our client agenda to drive growth. Then, furthering next generation platforms to support the future of transaction services. And lastly, driving innovation to deliver client solutions. Let me walk you through each of these. First, let's talk about our client strategy and how we're translating our strong foundation into future growth. So as you can see on the slide, we are enhancing our position with institutional clients, a key component of our 17,000 client base. This segment represents the largest and most operationally complex companies operating around the world. And as you heard earlier in the video, they all rely on Citi to carry out their day-to-day operations. And in many, many cases, we are the only bank that is able to facilitate their critical cross-border business. Our integrated FX partnership with markets serves as a key differentiator for us and a testament to our One Citi model. Andy will discuss this further shortly. As an example, over 90% of services revenue with Fortune 500 companies comes from clients doing business with us in over 10 countries. Our strategy for growing wallet share with this client segment is very clear and focused. First, we're deepening our client relationships in key geographies, with a particular emphasis on strengthening our position in North America. Second, we are expanding our market reach with innovative new solutions across our entire network. Now, in the middle of the slide, as you can see, we are focused on supercharging growth in strategic, underpenetrated client segments. We've made meaningful progress here and are focused on absolutely accelerating it. Starting with the commercial bank, we have a targeted strategy with a goal to be the go-to bank for mid-sized corporates for international financial services needs. North America is again a key market and represents our single largest opportunity. Within this segment, we've delivered an annual growth rate of 12% since 2022, significantly outperforming the global wallet. This performance also reflects our strong partnership with banking. You'll hear more on this from Viz later, but we are confident that we are incubating the next generation of global champions. For asset manager and owner clients, we are developing enhanced data solutions to provide a single multi-asset real-time view. Our investments in this segment have helped drive over 14% annual growth in assets under custody and administration since 2022. And finally, on the far side of the slide, we are capturing share in key verticals that continue to show outsized growth. As an example, we are capitalizing on the sustained growth in e-commerce, evidenced by a 250% increase in average daily instant payment volumes from 2022 to 2025. Meanwhile, our ETF servicing capabilities have enabled us to deliver over a 250% increase in our North America ETF business. In fact, BlackRock recently chose us to provide select middle office services for $4 trillion in US domiciled iShares ETFs on the Aladdin platform. So as you can see from this slide, our engagement with the world's most complex clients is paramount. And central to our strategy is a co-creation agenda that guides our efforts across our entire client book of business. This approach fuels our growth, evidenced by the tailored solutions our teams have co-created with leading institutions across e-commerce, fintech, and financial institution clients. Let me now talk about how our platform strategy contributes to this client agenda going forward. Again, as you heard in the video, the concept of co-creation is fundamental to our approach. It allows us to build technology platforms structured around our clients' needs, empowering them to run their businesses effectively worldwide. And Services continues to invest north of $2 billion annually to drive our platform strategy across our 5 businesses. And here, we are anchored around 3 foundational principles. You can see them on the left: real-time, scalable, and always on. A modern infrastructure stack, including our client-facing platforms, and a strong data and AI foundation, with a focus on speed, scale, and availability. These principles empower us to evolve our platforms and commercialize innovative solutions at the pace of a fintech. You can see some proof points on the right-hand side of the slide. We've doubled the number of applications running on modern architecture, which has made us far more agile and efficient. You can also see evidence of this in our custody business, where we saw a 37% increase in settlement volumes while reducing cost per transaction by 25% over the same period. Both these examples illustrate our ability to leverage technology for enhanced productivity and revenue generation. Another powerful example of our execution is the Citi Payments Express platform. As some of you may recall, we launched it in 2022, and it is already processing up to 10 million payments in a single day with the capacity to do much, much more. That volume represents nearly 40% of our total payment volume, which is a testament to its rapid adoption. This pace of commercialization, from idea to a core part of our infrastructure, is on par with any fintech, demonstrating our ability to innovate and win. And on top of this, we are differentiated by our ability to scale this innovation across our global network. Express is already live in 22 markets and will reach 30 by year-end. As you can see on the bottom right-hand side of the slide, these investments also enhance client satisfaction, as reflected in our latest surveys. We are very proud of our progress in client experience and remain committed to driving further improvement. Continuing with our platform agenda, let me spend some time talking about AI, which is integral to our strategy. AI's impact for potential and disruption is still in the early stages. However, we believe it is a transformative force that will allow us to reshape our platforms. Our AI strategy has 2 primary goals: enhancing our clients' business models, while also improving our own internal processes and operational efficiency. We are strategically deploying AI through specialized practical solutions. You can see them on the slide, structured around 5 pillars that directly address client and business needs. Critically, this is all governed by a close partnership with our risk and control teams. This has enabled us to build a pipeline of over 50 use cases across services, some already live, with the rest actively being built, demonstrating our ability to innovate safely and at scale. Each of these use cases should result in enhanced revenue generation, a superior client experience, improved client solutions, while also reducing operational overhead. Let me share with you the benefits of what we're already starting to see. On the left side, the sales assist pillar is a set of use cases designed to augment our sales teams. We have close to 10,000 complex client engagements annually. Our goal using AI is to streamline these engagements, which should result in, frankly, a significant reduction in sales cycle times, faster commercialization, and improved client insights. This should drive wins, revenue, and market share. On the bottom of the slide, you can see some of the other early results. By leveraging AI in our technology development, we've shortened cycle times, driven by a 30 to 40% boost in developer productivity. We expect these gains to increase as the underlying models continue to mature. Our intelligent
All right. Hi, everybody. Rainier, thank you. I love how much you exaggerate, but I'll take it anytime. We're almost at the end of all of this. Very, very excited to spend a few minutes with you here, Guy, in wonderful Miami. Because we don't have that much time, we're going to jump right in. So you've mentioned from time to time, especially recently, about a transition of crypto moving from hoodies to collared shirts. And I'd love to dive a little deeper to really understand exactly what you mean and what you're referring to. Is this a reference to institutional adoption, or are you talking about the maturation of technology? You know, what's the reference there?
Yes, it's absolutely that institutions are moving on chain and clearly beginning to adopt blockchains for finance. And I think Sui is an excellent example of that. The kind of quip or analogy is inspired by the social network. The comment of Zuckerberg and his hoodie and his "fuck you" flip flops. We are yes. Retiring those, and maybe starting to put on a collared shirt. You know, if you walk around the conference today, I think you see a lot more people in suits here than you did a few years ago. Yes. And I treat that as a very positive sign. I think this is kind of the industry maturing. I think in hindsight, we'll probably look back on October, November last year. Maybe 10.10 is one catalyzing event. And then some of the model releases with Open 4.5 and 4.6 is kind of an inflection point where one, AI agents need a financial ecosystem, and that I think is best fit and suited with blockchains. And then two, kind of a shift in the market structure where you had a lot of speculative energy for a long time, and now I think a lot of the focus is on using blockchains to upgrade existing core ledgers in finance, which I think is certainly the speculative energy is still wonderful, but it tends to come in cycles. And I think the product cycle and the financial cycle are sometimes, separate from each other and disjoint. I think that's kind of the period in which the product cycle really seemed to take off. And, I think in the fullness of time, usually the product and financial cycle kind of come back into unison.
That's a really insightful comment. Do you have any love lost for the speculation, or are you appreciating this newfound focus on button downs and college?
Yes. Well, I certainly don't think the speculation is gone. If you look at Wall Street, that they've been able to get themselves into a pickle or two before as well. I think a lot of it is a transition for the industry as a whole. I got interested in crypto very much from a cypherpunk attitude and perspective, and I think that ethos still permeates the space and inspires a lot of what we do. I think blockchain is both a technological and a social revolution, and I would compare it kind of to prior literal revolutions. I think you could look at kind of something like the French Revolution, where you had a drastic shift, and at some point Robespierre gets executed, and the revolutionaries have to start to govern.
Yes.
And it feels like we're at that point in time where maybe the initial inciting energy of crypto has pushed us far enough and kind of created the activation energy for traditional finance to come towards us and begin to reshape and kind of anneal, so to speak. That's something we talk a lot about, the idea of market annealing.
Yes.
That startups make themselves malleable and willing to change. The same way kind of industry incumbents make themselves malleable and willing to change. These two metals are fusing, and I think that's currently happening. Obviously that means we can't all keep our hoodie, but I'm more than happy to trade our hoodie for kind of FIDI moving north into Soho and moving on chain.
Absolutely. On traditional finance and institutions, the world is abuzz about stablecoins, tokenized assets, DeFi rails, but adoption and real world usage are very, very different things. Where are you actually seeing traction? Where are you seeing pull from the institutions?
Yeah, well, I think the first would be stablecoins.
Okay.
I think we see stablecoins in the developing world as a dollar-denominated neobanking account for everyone on Earth. Dollars are a fantastic product. And I think we see adoption from, let's call them asset managers and fintech companies, to not just distribute dollars through stablecoins, but also begin to offer other products that often monetize better. Things like investing in wealth management products, things like credit products. And that's why I think you see a lot of energy around capital markets on chain, around exchanges, around lending protocols. Then, similarly for stablecoins, I think you start to see larger enterprises, especially in the developing world, beginning to use them for efficiency. And I think a lot of that is very focused on payments today. I would say the regulatory shifts, notably the passage of Genius last year, very positive treatment from the U.S. government, really unlocked a lot of stablecoin and payment-specific use cases. We're very hopeful that some of the recent guidance from the SEC and the CFTC will unlock capital markets and kind of unlock the rest of what finance could be on chain. And obviously, we have clarity going through the legislative process in Washington. We're pretty optimistic about the potential there to also, not just literally enshrine in law that a lot of what we want to do on blockchain is the future, but to kind of unshackle the compliance department to say yes to some of the obviously useful business cases that have been in a bit of a gray area because of some of the, let's call it lawfare in the last administration.
Yes, absolutely. Very, very well known and well understood at this point. Shifting gears a little bit to AI, since we are talking about this intersection,
Yes.
I think one of the things that has definitely emerged, even though we're seeing tremendous growth in stablecoins and payments, we're also seeing a rise in security incidents. I think across the broader industry, in April alone, we've seen over 20 plus. If you're at a DeFi protocol and you are building, as many of the people in the audience here are today, what do you think the industry needs to be thinking about in terms of security in the age of AI advancement?
Yeah, I think, I guess my first point would be almost all of the hacks are not theoretical security hacks. It's not like we need to invent new security models. Almost all of the hacks end up being a misconfiguration or a human error. And I think really what needs to happen is the entire industry needs to take security more seriously. I think the fact that we're kind of asking the question is an important part. I would also say that I think this is not a crypto-specific problem.
Mhm.
I think this is just kind of how software is going to work for the next couple of years. I think we're back maybe in an early 2000s environment where the asymmetry, where a scripts kiddie by kind of the early 2000 lingo, or someone today with access to one of the cutting edge models, they're excellent at penetration testing.
Yep.
And so I think kind of software as a whole is going to be more vulnerable at this point in time. And so, especially in a crypto context where there's a lot of money at stake, you have to think about defense in depth. You have to think about real maturity in terms of how you run and operate a security team.
That's such a wonderful point, because if you use history as an example and you look at script kiddies and the way this has evolved outside of the crypto space, naturally what should happen is a hardening.
Of course.
As tools advance, we will catch up in that hardening, and then it'll just be this continuous up leveling
Yes.
as it is even outside of crypto and in the rest of the software industry.
Yeah, I mean, I think the positive framing of this, you could say AI is making things less secure. You could also say the AI models are so good
Absolutely.
that they are actually perhaps in many cases better at pen testing than existing human pen testers. And I think we have a lot of software that's been written over the last many decades that has not kind of been probably bulletproof to the extent it should be. I think a lot of the code written moving forward will be more secure as a result of being able to reference against the latest models to ensure your initial deployment is good instead of having to remediate in the future.
Do you need a loan for your business? Well, if you've been around for over a year, I'm about to show you how to get up to
Absolutely. So a lot of folks today have been talking about agentic commerce and the various flavors: agentic payments, agentic commerce, agents basically acting on behalf of us humans. What do you see, of course, from your perspective? What is real versus hype?
Yeah, I think the important question in what is real versus what is hype is usually like, what is the actual use case? Agentic commerce is a very broad term, and I think what is real today for agents would be coding. Agents are incredible at writing new software, and where do you need payments in the coding process or kind of the software development process? I think my simple answer would be it will be much easier to give your agent access to as many and hopefully every single API through the context of stablecoin payments and things like X402 or MPP than it will be to have to manage all of those API keys manually. I don't know if you've spun up OpenClaw and tried to give it access to iMessage, to Twitter, give it an email account. I think a lot of the challenges there are very simply, I want to give it access to as many services as humanly possible. And the API key management is actually really a pain.
Yeah, absolutely.
And so there are a couple of projects now focused on kind of doing discovery around those payment surfaces. And then obviously, I think the underlying blockchains themselves have gotten so fast. A lot of the work, you and the SWE team have done to make stablecoin payments essentially free and settle essentially instantly, make that a much better fit for kind of micro payments and the kind of per token request style that APIs seem to be moving towards.
So many of us on the SWE team have been monkeying around with OpenClaw and the like, and I still self-identify as a lawyer. I was a lawyer for many, many years, and so I generally think of myself attuned to risk, but just having to manage and resist the urge to give root access to my whole life is very challenging. So, when we look at the rails and the agentic rails, X402, the things that we just talked about, of course, when we look at how banks and financial institutions will interface with those rails, there has to be the question of why can't they just use traditional finance rails, them being agents, that is. Do you see a state where it is just purely stablecoin programmable money rails displacing only traditional rails, or is it a hybrid? Is it I'm going to use whatever is best for my use case at the time?
Yeah, I think it will be a hybrid, but the closest substitute for a stablecoin payment today would be a virtual card. And I don't know how many of you have tried to, for example, pay for things on chain through a PSP with a virtual card or with a credit card, but very often those payments get declined. Like I'm still consistently shocked when I try to Apple Pay on a crypto app that obviously depends on the app, but I was talking to a founder last week who was saying they were having something like 80% of the transactions declined by the PSP, which is just entirely unacceptable. And so I think there are hybrid solutions you could kind of cobble together an approach with existing cards. You'd obviously have to change all of the economics. Credit card fees usually charge a fixed 30-cent fee, and then there's very high interchange, which doesn't make any sense for micropayments. So you'd have to see a lot of how kind of existing payments work change very, very quickly, which I'm somewhat skeptical of. I think for things like consumer payments, the stablecoin backed card makes a lot more sense and is a wonderful hybrid solution. But I think for agents making very small value payments at very high volume on chain today, almost certainly stablecoins are the best technological fit for that. And it's really more of kind of a go-to-market question to ensure that the products and services that kind of we have as an industry have built get to market faster than the incumbents can upgrade their tech.
You just mentioned cards. We've also talked about X402. When you look at agentic commerce, there's, I think, a surfacing number of themes, either in the orchestration level, like stablecoin orchestration, also cross-border payments. Do you feel there's any underrepresented parts of agentic commerce that you would like to see more of?
It's a good question. I mean, I think the question with all of these things is what is the killer use case, right? Like on chain today, the two things that seem to really work are stablecoins and perps, and I think most successful crypto businesses are some second order effect of those killer apps. So when we're thinking about agentic commerce, my question would be, what is the agent doing? And I think the initial killer app there is payments for APIs and kind of API fractionalization, API key management. I think almost certainly there will be other examples here that this is more the domain of our AI team, but there are a lot of companies now trying to move from kind of API consumption on a per token basis to offering seat and services models. And I think, specifically what the agent is doing will make a lot of difference in kind of how agentic commerce flows out of that. What I do have pretty strong confidence in is that DeFi is essentially a financial system that I think really by accident fits perfectly with kind of the hallucinations that you maybe get from an agent, and with the ability for those agents to participate permissionlessly without going through some registration process. And so I think the high level details make a lot of sense today, but I would pay very close attention to what agents are actually doing very, very well, and then almost certainly there is some economic workflow there that becomes a really good fit for blockchains.
Thank you. That's food for thought, folks in the audience that are builders.
And if you're building a company,
love this. Yes,
we just raised a big fund.
Yes, congratulations
I'm
on
very
Fund
interested
5.
in investing in agentic commerce.
Yes, that's great. You heard it here. So we're almost out of time, but I want to ask a little bit of an offbeat question. knowing that the audience is who the folks are, is there any one strong belief or strong conviction that you actually think most people here would disagree with?
That most people disagree with? That's a good question. Oh, we should have talked about this beforehand. Yeah, I mean, I think one that is particularly interesting to me, I think we have a chance to build a whole new kind of credit ecosystem. So that would be one. Then I think, the second would be compute and energy, which I can talk about in a second. I think the massive number of dollars of outstanding stablecoins today, though, they will absolutely look for higher yield opportunities. And if you think of what a stablecoin is, at least Genius compliant stablecoins under American law look very similar to narrow banks. And I think a narrow bank is an interesting product, but if we move all dollars to stablecoins, we'll have much worse capital formation if we replace existing banks with narrow banks. And so I think there's a real place for vaults and lending infrastructure to build a new kind of credit market or new forms of capital formation on chain. This also kind of rhymes with how lending has worked outside of a crypto context.
Yeah.
Before the Great Financial Crisis, you had a lot of direct bank lending that shifted, both in part because borrowers wanted to have a direct relationship with their lender and because of regulation like Basel III, which changed kind of the capital requirements and return on equity capital for a bank. So banks started to lend much more towards private credit funds.
Yes.
The private credit, equity buffer would be the first loss as opposed to the bank, which a number of regulators were very positive about and was kind of the shift they wanted to see. And so who do private credit funds actually really lend to? Well, usually that ends up being a private equity sponsor that is, taking a loan from a private credit fund and buying a business in order to transform it. And, I think private credit is in an interesting place today. With some of the redemptions that maybe you've seen in the news. And I think there's an opportunity with kind of how credit works in the traditional world changing and, the real demand on chain for, vaults as a result of stablecoins to kind of see these two trends come together. And I think we're in an interesting moment for that. So we've worked with a number of companies there and I spend a lot of time with Morpho, which is top of mind on this.
Yes.
Then I think kind of the other things, I think we have AGI. Maybe that's my hot take that people would disagree with. I think the important component to scaling it is access to compute and access to energy. So both physically can we make the chips, but in many cases, data centers are sold out of capacity through 2028 or 2029, depending on who you talk to. And it's actually very hard to get powered land. And so I think this is not just a technology problem, but this is kind of a coordination problem or a capital markets problem. I think blockchains will be very good for that. I think when we see kind of new asset classes emerge or professionalize, perhaps in the same way that payments in the developing world leapfrogged from cash to touchless on your phone, we never really had physical credit cards in large parts of the world. I think sort of new capital markets for especially compute and energy might move from being largely traded OTC to being traded on a blockchain directly through a decentralized exchange. And so I think that's kind of one of the most important questions. And if we believe in agents and agentic commerce working really well, I think you obviously need to be able to literally serve the tokens that power those agents. And probably the most important part of that today is being able to produce more energy and being able to produce more chips.
Marketplaces for compute, the world's most important resource.
There we go.
Absolutely. Absolutely. Very quickly on the lending and loan portion that you had, do you see any particular opportunity when you're comparing even traditional loans in like student loans, auto loans, or is this really more limited to the private credit piece and solving actually the private credit dilemma?
Yeah, I think it will come in all forms. I don't think it's specifically related to private credit, although I think we've seen a lot of energy from some private credit asset managers who want to move on chain today. I think the other version of this would be what Figure has done with HELOCs.
Yes.
I think that they have a really interesting playbook there. And if they've done one thing really well, I think it's understand the customer and kind of meet the customer where they are today. And so I think that's again this process that crypto is going through, where we've built fantastic technology, and I really don't think we have kind of a technical bottleneck to adoption anymore. I think it's much more about understanding what the existing customer needs and kind of being willing to meet them where they are and sell a product that they can use from day one.
Amazing. Guy, thank you again for joining us on this very dense day.
It's fun. Yes.
And thank all of you in the audience as well for
Thank
being
you all
with
for
us.
coming.
I'm going to do something a little bit different today. It's a whole different framework that none of you have seen before that I've been developing over the last, well, 35 years of my journey through markets, but also in the last 2 years with my journey through AI. It's a operating system for the universe, bizarrely. It's kind of understandable, it's provable. It's how all systems thrive and survive throughout every observable part of the universe itself, whether it's biology, whether it's ecology, whether it's cities, whether it's blockchains. It applies to everything, technology, the human body. It's called the everything code, the universal code. The universal code is a much bigger body of work, but I'm going to show how, for the first time ever, it applies to blockchains. And I think it's going to be very different and hopefully interesting. There's a lot to get through. It's more dense than my usual few slides and a banana, but I think you'll enjoy it. So let's start with the universal code.
Every breath tells a story. Noe unfolds yours with an 8-minute breath.
We are joined by two great trailblazers in digital assets. We have Gabor Gorbach, who is the CEO of Open Assets and who had actually served in multiple other seats prior to that. And we have Matt Horn, who is the head of digital asset strategists at Fidelity Digital Assets Management. Both are trailblazers, but they come from two completely different perspectives and backgrounds. So first of all, maybe we start with Matt to hear from you how you got to becoming so involved in digital assets within Fidelity, and maybe tell us a little bit about your background, and similarly with Gabor. And as you introduce yourself and your background, I think the first question is, out of $100 trillion of RWAs that are going to come on chain in the next 5 years, hopefully, how much of that you think is going to be on public programmable chains versus on private chains in a walled garden? Matt.
Excellent. Well, thank you all for having me. Matt Horn, I run the digital asset strategist team at Fidelity and some of the product function as well. So think of us as really another asset class within the broader asset management organization. So we believe crypto is an emerging asset class that warrants the attention and sophistication that we give all of our other asset classes. So it's a very exciting time to be part of that at Fidelity. I've been here 14 years. My first half of the career was spent in exchange traded funds, which for those of you who don't really know, that vehicle really disrupted the mutual fund industry tremendously the last 20 years. So I had a front row seat to kind of that disruption and watching it play out. And at the same time, I got exposed to digital assets, and I had my wow moment that was, this is going to change everything. And that's kind of how I pivoted 7 years ago into this role now. So a lot going on at Fidelity. We spend a lot of time with clients focused on crypto as an asset class, but also crypto as an enabling technology, and really bringing real world assets on chain, tokenization. And it's a massive opportunity for asset managers. Bold predictions, 2030, trillions coming on chain. I think it's going to be split, right? You're going to have use cases for permission chains and in public chains. And just knowing how institutions operate, it's going to be slow and methodical and risk averse. So maybe you see a slight tilt in some use cases toward some permission use cases, right? Other institutions might be more comfortable with this technology. They've been playing with it for a lot longer and using it for different use cases. Maybe they go more aggressively toward a public chain use case. But I think like most things over time, it'll be a mix based on the use case. But either way, I think it's an exciting time to be in this industry. So,
thank you, Matt. Gabor, what's your take on this?
Perfect. Hello, everyone. My name is Gabor Gorbach. I'm the CEO and founder of Open Assets, and also advise Tether. I spent my career building infrastructure for digital assets. I was an engineer in 2012 at Bitstamp. There was not much crypto going on at that time, just Bitcoin. And then I got a real job after that, joined the asset management industry, and built VanEck's crypto division. In that capacity, we're the first asset manager to file for a Bitcoin ETF. And I was the guy that was running around Wall Street and presenting to boards at various companies about, putting crypto assets into, and at that time, again, Bitcoin into ETFs. And then I changed my career from putting crypto into ETFs to putting ETFs on crypto. And it's kind of interesting because what Mustafa mentioned, there's this 100 trillion revolution going on. So it's really difficult. I've built some of the consequential ETFs in the market, especially those with specialty exposure, Bitcoin, semiconductors, esports, emerging market country exposure, and the ETFs are efficient instruments, but the infrastructure that it runs on is extremely inefficient. It's basically 50 to 60-year-old technology and paper pushing back and forth. So that's what we are working on that's what we are fixing with open assets. And we power some of the largest category defining leaders with our technology. And again, we work with Sui, of course. This is a performant and reliable chain. And we work with the Intercontinental Exchange. We work with Amazon. We work with Tether, the largest stablecoin in the world, and a bunch of other banks and nation states and around the world, providing this technology in a way that everyone can use.
Thank you very much. Yeah. So thinking, Gabor, maybe kind of continuing with you, most tokenized assets today are effectively a line and a ledger in an ERC20 or ERC3643. As you think about scaling this and kind of thinking about the asset as something that carries its own attestation, compliance, restrictions, all things that are characteristics of that asset, do you think that the kind of account-based ledger is going to continue to be successful, or are we going to need to treat those assets as objects on chain that are treated as a first-class citizen and carry their own metadata and their own compliance rules with them?
So I think it's going to be a mix. It depends on the use case. I'm fundamental in the belief that, again, maybe I shouldn't say it to this crowd, but like blockchains are dumb infrastructure. They're specifically designed to solve specific problems. You can't do everything on a blockchain. You can't do all of your compliance on a blockchain. You can't do real-time trading. But it's important that certain type of data is embedded natively into the blockchain as an object. And not many blockchains do that effectively. So blockchains do need to get smarter. So I'm on the opinion that blockchains like Sui will win over time because it's important to embed some type of data into blockchains, particularly the origin of transactions and the destination of transactions to comply with things like the travel rule, asset characteristics, and so on. But I don't think that identity specifically should be embedded into blockchains. If you embed, so basically, trusted third parties are security holes, and if you put a lot of data into something, it will eventually get hacked. So my view is that you should put some data, but not much. And yeah, so that's a quick summary.
Do you have a take on this, or do you want us to move to the next question?
You can move on.
Okay, perfect. So this is a question for both of you, but maybe we start with you, Matt. Delivery versus payment. One of the most painful things, and me coming from traditional finance as well, is the fact that you have fragmented ledgers. It is everything is trapped as capital because you have a T+1, T+2 settlement. And in fact, for those that know, some assets actually settle on T+50. So you literally are sitting on risk for 50 days and that you have to hedge and that you have to hold capital. Syndicated loans is a perfect example. But when you are trying to compose multiple legs of a transaction for an asset to settle in a DVP, so things like custodian attestation, custodian approval, stablecoin payment movement, the actual asset itself, there are many things, tax withholding. There are many things that you actually have to align to create this type of a DVP transaction. And so the question is, when you think about that, what are the actual limits that we might start hitting when we think about DVP, but at the same time, you think of multi-step transaction that would require all of them to either all happen or none of them would happen?
Yeah, it's quite a problem on the TradFi side, and hopefully, with this technology, we can find efficiencies to mitigate some of the complexities here. I think today, basic trades are probably pretty efficient on chain, where you're just doing cash for an asset. But the reality is, I think most institutional trades are complicated. They're multi-leg, 5, 6 legs, and you're dealing with multiple assets, multiple custodians, counterparties, maybe tax implications that all have to get kind of considered for. and settled atomically, instantly with assurance. And I think it's a complicated problem. And you also have to have the assurance and confidence that it'll be secure, it'll scale, and that if every institution that wants to play on chain can do it with confidence at the same time. So there's a capacity consideration there too. So I'm optimistic. I do think this over time we will get there. I just think today, maybe not today, right? But I do think as more assets come on chain, more institutions get involved in a serious manner with this technology, I do think over time we'll probably get to that panacea state. But I do think over time with DVP, I think you're going to maybe mitigate some of the frictions right now, but it won't be perfect, I guess,
The police officer at the scene told me to never sue the driver who crashed into me after my car accident. I took his advice.
Your time, so.
Gabor, I don't know your take on when you think about things like programmable transaction blocks that Sui, for example, offer that would allow you to do up to over 1,000 transactions within a single block, and it's kind of all or nothing. I don't know if you think that could be a potential solution for a problem like this, where you have multi-steps, but at the same time you want to guarantee that no single-sided transaction and risk associated with that to happen.
Yeah, I mean, Mustafa basically solved the problem already. I think the world is just yet to realize it, and the legal infrastructure has to change behind it. So I think, again, the problem is solved. And if you use something like Sui and use the open asset stack with its matched open agents transfer agency, you can get near real-time transaction and delivery versus payment. It's solved. It's near instantaneous. Now, things get tricky when you have, brokers holding capital and funding times get tricky, but once people realize that the DTCC is largely irrelevant, then DVP will not be a problem. The reason DVP is a problem is because brokers are making too much money, and the DTCC inserts itself to an equation where they are no longer relevant. So again, as of I have two colleagues, Jeff Bandman and Surendra Kaladindi here. It was 12 weeks ago, the SEC came up with transfer agency regulations that modernized the rails of how transfer agents can facilitate securities transactions and how to report about it. And so, after that guidance, we came up with the first transfer agent that is basically abides by those rules, and we can do things faster and without the DTCC. So again, you should talk to those two guys, Jeff and Surendra, if you want to learn about it. But I think you'll see basically the rest of the year, very large entities coming up with structures where you don't see central clearing and the DTCC being the main organization. And so again, I think DVP is just one of many issues that you end up fixing if you disintermediate a broken system that's 50 years old, or 60 actually.
Very well said.
You have any thoughts on your background?
I think fundamentally you will need something that can actually combine a complex process that will rely obviously on things like oracles and data sources. So not everything obviously going to be on chain. But I do think something like a programmable transaction block that guarantees you could actually create a very complex process within a single block that either all executes or reverts back is a perfect way of solving for DVP issues across the different types of asset classes. Great, moving on to the next question. So imagine tokenization work, which we all know will work. And fast forward 2030, we have $100 trillion of assets that are living on chain. They are used as collateral for repo, for derivatives, for private wealth. Now, all of a sudden, you have activity that is at an incredible volume, and especially when you pair that with potential AI and agentic payments and agentic trading. When you start thinking about this and you start thinking about scalability, are there winning chains that are going to be able to handle that type of volume, or are we going to get into the 2021 Ethereum congestion issue? And is there a monolithic kind of model here realistically, or are we going to be relying on layer 2s that introduce fragmentation? What are your thoughts on that front? Maybe, Gabor, we start with you.
Yeah, I think, first of all, we're not going to go to instantly T+0 settlement, and not all transactions will be on-chain. So that's my first answer. We're going to go to T+6 hour settlements, and then realistically T+3 hours, and we're going to get stuck for years in the T+3 hours world. And then we're going to go to T0 settlement. And because of it, I don't expect blockchains to be needing to perform better than they are today. I think a lot of transactions will still not be on-chain. Realistically, a lot of the transactions will be badged, executed at the end of the day, bundled, lent against. And again, I personally see this as a non-problem because institutionals are used to badge transactions, and I don't think that nature of the business will change. Hence, we already covered what we need from a capacity perspective. So that's my simplistic view. If the entire world would just go on-chain, sure, then we have somewhat of a problem. But the solution will not be layer twos. And again, I started with this with a strong statement that blockchains are not great for many things. And so not the whole stack will be on blockchains. I think some of the performance problems will be just solved through superior technology, and blockchains will be matched with superior technology to solve problems.
Yeah, I think that makes sense. Not every asset needs to go on chain, right? I think, again, fundamentally, if an asset is inherently illiquid, a real asset, and it goes on a blockchain, it doesn't make it liquid instantly. And I think we've kind of seen that the last few months in some cases. So it'll be a mix, right? I think you'll have chains that can handle a lot of this in their natural stack. I think you'll have some layer twos that solve some of these problems too, in some cases too. So I think it'll just be a mix over time.
Yeah, I mean, I have to agree with you, Gabor. There are definitely going to be business practices that will not change just because of the nature of the blockchain and what it's bringing. So if we think about netting, for example, which banks heavily rely on, multi-party netting, that obviously will not go away because it gives an incredible capital efficiency for participating banks. But I do think as we get more and more assets, and hopefully we get to that 100, 200, 300 trillion dollars very soon, I think the amount of activity, especially when it comes to bringing AI and agentics on these chains, will actually explode. So while I agree with you, it might not be a problem in the near term, down the line when you have all of these assets and agents moving them all the time, you're going to start hitting some limitations, and you're going to need to figure out the right model and the right blockchain. So I think we are partially in agreement on that one. When we think about most of compliance capabilities today, they are all kind of bolted on multiple platforms, try to make sure that you are remaining compliant with different types of transactions. But eventually, and I think we've kind of touched on this earlier, do you think like transfer restrictions, jurisdictional whitelist, and attestation requirements need to live on the protocol level or on the asset level? And so, Gabor, maybe if you can share with us how you think about this problem specifically.
Yeah, again, maybe it's not surprising at this point for you. I do have a strong view on this. So my strong view is that I believe in freedom, and most things shouldn't live in the token. Some things should, but most shouldn't. So if you end up adding more and more information to protocols, it means that it becomes more and more incompatible with other systems. So the more you embed into the token, the more you restrict your distribution, and that's a problem. So I like to think that some of the functions related to compliance for tokens will remain centralized. And I think 10 years from now, we'll still have, fortunately or unfortunately, compliance officers at banks and financial institutions. And I think they'll just use better technology to pre-screen people to use tokens. For instance, with open assets, we have a full stack, basically a drag and drop system whereby you can collect information from 130 countries and individuals, businesses, and so on. You can custom tailor your distribution in a centralized platform. Then you can deploy a basic SUI-based contractor and other chains too. We're chain agnostic, but SUI is available on the platform, and you can be certain that your compliance requirements are met under your compliance officers programs. But like that piece remains centralized. because of the explosion in brokerage and crypto exchanges, we got much smarter on how to collect information about people and businesses. And actually, one of the controversial things I like to put out there, and bankers hate it, is that crypto companies now do a better job at AML, KYC, KYB, and KYT than banks. We are 10 years ahead. And the solutions happens to be centralized, and the tokens can be freely distributed, which is, I think it's just kind of cool. Maybe I don't mean to be rude to Fidelity.
No.
He's on the asset management.
Yeah.
Well, yeah, well, I mean, but you know, we're talking hundreds of trillions coming on chain. It's all asset managers bringing products on chain, and these are all securities, and asset managers are beholden to very strict regulations on how we distribute those securities, right? And this is where it all comes together: compliance, KYC, AML. But how do you do it at scale on chain so you can have a better, more crypto native feel to RWA distribution, right? Peer-to-peer, things like that. And yeah, I think there's a lot of things getting worked on now, but I think that's going to be one of the great unlocks, right? It's sort of like on-chain identity, and how do we, know who's buying these products? Are they doing things in a compliant manner? Are they doing nefarious activities? Whatever it might be. But I think that is a massive sort of unlock for this to go to the size you're talking about here.
Yeah, I have to agree that tokenization and having things on chain improve compliance materially and make it much, much more effective. And part of my work at Goldman, I looked at financial crime compliance uplift for a while. So I got very much involved in understanding the complexities around that ecosystem. And the reality is that something like blockchain, something where you can actually have traceability, auditability, embedding certain rules within the assets themselves, is going to solve a lot of these issues and allow for a much more fluid ecosystem than what exists today.
I mean, absolutely. Even like crypto is global, and that's a massive opportunity for asset managers. You can now, in theory, distribute to a universal client set that maybe you couldn't touch before, given jurisdiction issues. And this is going to be a massive unlock, I think. Things like where are you geographically located to buy a product, that sort of stuff, right?
And by the way, again, just to contextualize why that's important. So 92% of the world does not have a brokerage account. You guys are lucky, and we're lucky to have a brokerage account, but not 92% of the world. 62% of the world still does not have a bank account. And it's because of the jurisdictional issues. It's because you cannot really learn about those people. Tech was not good enough. And I think with blockchains embedding some of the information, you can get a better, faster, and cheaper and more transparent system. So that's sort of from the, Matt mentioned earlier, the ETF world. Like when I joined, Matt is a little bit older than me, although he looks younger. So I joined like ETS around 2013, and 2014 I was talking with the large banks, wirehouses who were buying the ETS that we were creating. And ETFs were roughly about $1 trillion in assets. And I've been talking to this bank and pension fund. They looked at me like I was a drug dealer selling them ETFs. Because you know why? Because there was only $1 trillion in assets in ETFs. They were buying hedge funds and mutual funds, and it was just simply an unusual structure for people to buy. And today, I think, at least like towards the end of the year, we're going to be in a similar situation.
Mm-hmm.
We're rapidly getting to the trillion mark in tokenized assets. We're sitting a little bit north of $400 billion today. And people are just asking the question, should I own a tokenized asset? And, some of these larger institutions are thinking when there's the Strait of Hormuz is closed over the weekend, and I can trade oil 24/7.
Mm-hmm.
But, the stock exchange is not open. The brokerage houses are not open. At some point, you have a fiduciary responsibility to provide ability for people to access assets.
Mm-hmm.
And I think it's going to be really rapidly suctioning out assets from ETFs, mutual funds, and other places into tokenized structure.
You and I both came from ETFs, right? So I think we like the analogy a lot. And it is a great analogy for what I think tokenization is going to do. The first ETF in the US launched in 1993. And it took literally 20 years to get $1 trillion in that vehicle. And now it is going gangbusters. It's going vertical, I think 11, 12, 13 trillion now.
Just in the US. Globally, it's even 24 or something.
Yep. Yeah. And here we are with tokenization, which I truly view as the next vehicle for investment distribution. And it's going to take time, and it's early stages still. But I do think we're going to get to a point here where this is going to hit kind of escape velocity. It's going to go quick. And I've been in this space for 7 years. I've never been more encouraged because you have the true institutional adults now in the room talking about not so much crypto as an asset class. That was a few years ago. That's kind of here. But now it's about infrastructure, tokenization, the enabling technology of digital assets. So it's a very exciting time for this.
Yeah, I would just add democratization of access is a huge premise here, because not everything when it comes to operational efficiency is all about operational alpha. It's actually about being able to offer the service to a broader set of people without having to incur this massive cost. And that's the reason why we have this disconnect between the wealthy people that have access to brokerage accounts and bank accounts and people that basically cannot afford it because it's too expensive to do it. And I think tokenization, automation of compliance, automation of movement of assets, releasing trapped capital is all going to translate in some way, shape, or form into distribution of these services in a much more democratic way globally. Matt, you deal with pension funds and institutions day in and day out. And when you talk to a pension fund treasurer, they don't particularly want to manage gas fees or gas tokens. They don't want to sign 14 transactions to be able to do one thing. They don't want to worry about MEVs. From your perspective, those are your clients. What is the optimal user experience would be for for traditional institutions that are trying to participate in this ecosystem?
It's a great question because they control a lot of capital, right? So you got to keep them happy.
All the capital. I want that 100 trillion.
I think one answer is just abstraction. Like, how do we abstract the complexities of how we engage on chain and with digital assets for them, right? And I think that's where asset managers like Fidelity and others can really bring their digital asset expertise to bring solutions that abstracts that a bit away. They want certainty, they want finality, they don't want fluctuating fees on something they're invested in, right? So they want a partner like a Fidelity to help them navigate that space. So I think a lot of it is, hey, we'll do it for you now, right? And help you on your journey and just get you into the asset class and the exposure you want. But I do think over time, as platforms abstract the crypto complexities away and it feels less crypto to these kind of non-crypto institutions, I think that's where it really takes off, right? And even on the retail side, I think the same way. The ability to give clients the ability to interact with DeFi is very exciting, for a firm like Fidelity. But if it's complicated and multi-leg for a client to do, you may not have the adoption you want, right? You want to kind of abstract it a bit away. So I just think that's where this goes across all these customer segments, not just institutions.
Yeah, very well said. Do you think there are blockchains that offer the primitives that would allow you to do that abstraction in a much more efficient way? Or do you think all blockchains are created equal and you're going to have to suffer the pain of doing that abstraction yourself?
No, they're not all created equal. I think there'll be winners who do it well over time, right? So
thank you.
Yeah.
Perfect. Okay.
You want me to respond to Mustafa?
Yeah. We have a million more questions and we can continue going, but I think I'm going to jump to our last question for both of you. And so one bold call from each of you. By 2030, what's the single piece of infrastructure or chain capability we'll look back and say that was the unlock, and something we are underestimating today, but we will realize that this was the bottleneck that we needed to deliver so that we can get to the many, many trillions of dollars that we want to see on chain.
Perfect. So what's the solution to $100 trillion problem, right? So again, I'm extremely biased on this, but I think in an odd way, the solution I think is Web 2.5. So how do you merge existing systems with this new technology so that we can transition into better technology? So that's what we're building with open assets. Is if you want to launch an asset on Sui, but you need a transfer agent, you want to settle into a central depository, you want to pay dividends, do all the TradFi stuff, you can do that on a simple platform that is we built for you. So I think that simplicity and simple UX is what we need to unlock this $100 trillion. So that's sort of what we're building. And it's really, really difficult to build simple UX merging all the traditional stuff with blockchains like Sui and other things. So that's my answer.
Short answer over time is, on-chain identity, scalable solutions there. I think it's huge for asset managers. So that'll be a great unlock looking back 5 years. So,
gentlemen, thank you very much. Thanks, Gabor. Thanks, Matt. Please put your hands together for these wonderful.
Welcome, Debbie, Ben. It's a pleasure to have you both here.
Likewise.
Before I kick off, I generally like to throw out a fun question before we get started. So I know that both of you are from New York. We're in Miami. I believe we've been in Miami for the past couple of days. What's been your favorite meal so far?
At empanadas.
Where?
An empanada.
Yeah, empanadas.
Empanadas?
Yeah.
Here, we had empanadas upstairs.
Yeah, I'm gonna get one after this.
Okay, awesome. Debbie?
Gosh, oh, you know what? Joe's Stone Crab.
Love it.
Yeah, and also fun fact, I was a resident of Miami for like a year and a half up until half a year ago. So it's like being back on old stomping grounds.
Amazing. I'll need to get Rex from you for all the hotspots.
Definitely.
Great. Well, let's get into it. We're here to talk about the next generation dollar. And I think both of you work at organizations that will help pave the way for what that looks like. So if I could start off with you, Debbie, do you want to tell us a little bit about yourself, Privy, the Stripe company, and how you guys are working on the next generation of dollars?
Yeah, absolutely. So my name is Debbie. I head up marketing at Privy. Got acquired by Stripe last year. Bridge is also a Stripe company, so we work very closely together. I guess Privy, in a nutshell, we provide wallet infrastructure to make it really easy to embed managing digital assets within your existing app. And so when we talk about digital assets, that obviously includes the next dollar, whether that be stablecoins or whether that be other kinds of RWAs, cryptocurrencies, and yeah, just here to make that whole experience accessible to both the end users and teams building on that technology.
If you're looking for business funding, stop wasting time with traditional banks. Get matched with lenders who...
Ben?
Bridge is basically a stablecoin company, like no more or less. We would always pitch ourselves as Stripe for stablecoins until we got acquired by Stripe to build stablecoins for them. But the whole goal is to do whatever you want to build on stablecoins. Can we give you an API to do that, right? If you want to mint stablecoins, burn stablecoins, hold stablecoins, spin them on a card, right? Issue your own stablecoin, whatever it is. We want to give you APIs to just make that seamless, so that you don't have to worry about the fiat side, the kind of financial operations, the regulations, all of that we can handle, and you can go build, financial applications. You can integrate stablecoins into your business all through our APIs. So anything you want to do with stablecoins is kind of what we're trying to do, and continue to expand that bundle to make it a one-stop shop.
Awesome. And since the acquisition, as you mentioned, Debbie, how has that changed the roadmap for your two individual companies, if at all?
Yeah, I mean, I think it doesn't really change the roadmap per se. I think it expands the opportunity of what we can do together. So, I think before we came together, we had could integrate Bridge via an API, and now we're able to abstract away that even more by having a native integration. And I think we'll start to see that a lot more as well with existing Stripe products, where everything was technically feasible, but I think as kind of three companies come together, it makes for an incredibly powerful stack, and also simplifies the process for a lot of people that are starting to look to build on crypto and stablecoin rails.
Yeah, I mean, for us, it was going bigger faster. There were a lot of enterprises we were talking to in Q3 of 24 that were like, yeah, this is interesting. Stablecoins, I kind of get it. Maybe we'll have like the Skunkworks innovation team that'll look at it. We'll run a pilot, we'll see. And then when Stripe bought us, they all called back and said, what are we missing? Like, we need to go figure this out now. And we had a lot of these enterprises, like Meta announced last week, right? Fortune 500 companies that it's clicked, right? And having the backing of Stripe and the go-to-market motion of Stripe and the kind of aha moment that they can bring to these enterprises made the entire thing way more real to these large international companies to build on stablecoins, whether it's Bridge, or Privy or somebody else. It kind of like validated a lot of this at that macro scale and just really pushed us to grow up fast and go big fast.
Going bigger, growing faster. On that note, from the regulatory standpoint, I have to ask, I know we don't like talking about that, but I do think we're having a very big regulatory moment, which is why we are seeing these large announcements from enterprises like the Metas of the world. What does a stablecoin bill mean for you two?
It brings us out of the gray area, right? Like when you're a large regulated institution, right, a multi-billion-dollar enterprise, a public company, you can't operate that much in the gray, right? And like we get stablecoins, we get your, legal positioning on how you move them and why it works, but it's still too gray for them to get comfortable. And so I think we saw when Genius passed a year ago, it brought a lot more comfort to these compliance teams, these legal teams at these large enterprises to say, okay, we're comfortable moving forward now. And so I think it's just really providing that clarity to the market to say, here's how you do it. Here's how you do it within the law. Here's how like your individual regulator will treat stablecoins from an accounting point of view, from a money movement point of view, from a banking point of view, that allows them to actually go ship something that they don't need to worry about looking over their shoulders at every turn. So I think generally the regulatory turn has made it a lot easier for these enterprises to move quicker with a lot more clarity.
Yeah, I would say I think from a historical perspective, has always believed in, how do we make digital asset ownership easy? How do we make digital identity easy? And hence historically we've always offered non-custodial, self-custodial wallets by default, and that you own your own assets, no one can kind of take that away from you, and that has also allowed us to expand globally to over 180 countries, like in a way that has been pretty seamless. I think when a regulatory landscape comes into play, as Ben pointed to, I think having that clarity makes enterprises more open to embracing it. When there is, a lack of clarity, that generally is going to be hesitation about, do I want to rebuild my financial stack or add to my financial stack if in 2 years all of this is going to go away? So what we've seen for sure as a result of regulatory environment is, again, a lot of enterprises, a lot of institutions starting to embrace stablecoins, and Privy now being able to serve them as well, and also working with Bridge as a licensed custodian partner to really expand the kind of offering that we have.
Excellent. You mentioned enterprises adopting stablecoins. Let's drill into that a little bit. Bridge obviously launched their stablecoin issuance platform. I'm curious, from your perspective, what was the motivation behind that? Was it because you foresee a future of more stablecoins?
Yeah, I mean, 100%. Like that's like the basis of Bridge since the beginning, was that there will be more and more and more stablecoins, because you want to control how a stablecoin moves within your ecosystem, within your platform, right? We see it with, Sui dollar, that like you want to say this is native to our blockchain, right? The reserves can be reinvested into our ecosystem, right? We can build features in this asset that are explicit to us, and we don't need to rely on a third party, right? We see this all the time with the fintechs and the payment companies that are building on Bridge, that there are conversion fees, between dollars and stablecoins that don't make sense to them, that there are earning opportunities that they're missing. There's branding opportunities. There's customization and control that they want, that they can't get from somebody else's asset, and they want to issue their own. And so we've seen this with, the native markets team in Hyperloop. We've seen it with Sui. We've seen it with the Phantom team, with the Klarna team as well, that like they want to control that asset that they're building on and not rely on someone else to kind of be a benevolent partner into perpetuity, but also that there's, right, if you have a lot of money sitting in stablecoins on your network, you want to earn from that, right? Mm-hmm. There's a pot of money that's great for you. And if you're not earning on it, you're effectively paying rent to somebody else. And so it's the customization, it's the earning opportunity that people really want to control how that works. And I think what we're starting to see with Sui is that customization really get pushed forward to say, what does it mean to have a stablecoin native to us? And how can we make that work better for us? Which is really unique.
I definitely think that it really helps streamline the work that we're doing so that there's no unnecessary work being done.
1000%. Paying rent to someone else is a touchy point for me. I just recently moved to New York. So if you know, you know. How is that platform going right now, the stablecoin issuance platform? And what types of organizations would you like to see start issuing their own stablecoins outside of chains and crypto wallets?
Everyone. I mean, that's I'm talking my book.
Bitcoin.
Yeah, they tried internally. I told them no. But I think if you're holding any sort of balance in stablecoins and you're not earning on it, it immediately becomes a question of like, why not? Right. And so I think that's the first point a lot of people trigger is like, if I have a wallet or a marketplace or any sort of platform that's holding any amount of money, you should look at issuing your own stablecoin, right? If you're a payments company that's doing a bunch of throughput, you should look at how do I build an ecosystem around that asset that I'm paying out. And so like, I actually like, it's joking that I say everyone, but I do think that there will be this explosion of ecosystem tokens in a platform like a Bridge that makes it seamless to have a clearinghouse between them, right? So you don't need to know, right, that I'm holding Bencoin, you're holding Debicoin, you're holding LisaCoin, yeah. But it'll just happen like atomically that we can swap between them. We don't need to actually think about that. But when money's at rest, you want to control a lot of how that works. Or when money's existing in your ecosystem, you want to control how that works. So like, I do actually believe that any large payment platform, any large fintech, finance company, bank, tech provider is eventually going to have either a stake in a stablecoin that they can kind of derive the design of to a degree or their own.
And maybe to add to that, I think kind of as the wallet, which is really the control plane for holding all these different stable coins, it's important for us as Privy to enable that kind of swapping, like as they handle all of the orchestration on the back end, that we enable swapping natively with just a single API. And we're already seeing that we wrote that out, built on Uniswap, and we've already seen kind of people starting to use that and really being able to switch between stable coins and other assets in a really seamless way.
Yeah, so quite frankly, there are a lot of other stablecoin issuance platforms out there. And when SWE was taking a hard look at the market and deciding on who to collaborate with and partner with, we really saw the value in the network effect, to your point, Ben. We saw Hyperliquid, Phantom, MetaMask choosing you as a destination to issue their stablecoins in terms of the platform. And we believed as you continue to grow that product and service that we wanted to be part of that network. Because at the end of the day, stablecoins, it is a liquidity game, it's a distribution game, and we wanted to piggyback off of that Stripe network. And the fact in partnerships with Privy, you have the entire stack to continue to grow your crypto product suite. So ultimately, that's why we decided to partner with you all.
And it's great to see it actually come to fruition, right? You've got this Stripe on-ramp, right, that you can use. You can just make it feel like a dollar, which is an amazing part of like this family of products, that you can treat stablecoins just like any other asset within your network without having to make it feel like an unnatural jump. And I think y'all have done a great job in normalizing that throughout the Privy, Stripe Bridge stack.
Yeah. Well, you just let the cat out of the bag. We actually wanted to make an announcement here today. No, you did well. This is great. This is great. This is great. SWE Dollar is now officially live on Stripe on-ramps. You can on-ramp directly into SWE Dollar via fiat currency from ACH, wire, debit, instant ACH credit here in the US today. You can purchase your first SWE Dollars downstairs at the booth via our first-party product Slush Wallet. You can then immediately take that balance and deposit into our Slush strategies to earn extra yield. So if you haven't done so already, please stop by the booth and pick up some SWE Dollars.
Yeah.
Yep.
That's awesome.
In addition to that, we actually have a lot of plans for the SWE Dollar, and I'm hoping that we continue to collaborate on that. But before I jump into that, I do want to touch a little bit about just stable coins in general being used in the real world payments economy versus how it's currently being used, or rather currently dominated by DeFi and trading activity. There's been a lot of data that's been shared, and there's a wide range of what people believe to be the real world payments volume. I have a point of view, but I'm very curious to get your thoughts on what is the current split of usage for stablecoins from trading perspective, and trading in the sense of using it to buy cryptocurrency versus using it in the real world economy for people to send each other stablecoins peer-to-peer, for businesses to settle in stablecoins, and for merchants to accept stablecoins as a form of payment. What does that split look like to you?
Well, I clearly have not done the research, but I will share a statistic though.
Sure.
I think not too long ago, the share of in Privy today powers over 120 million accounts. Not too long ago, the share of stablecoins in Privy wallets was called 20-odd%, and now it's at over 70%. And I think a lot of that is a result of, obviously we do have a number of trading customers, so not to say that they're not using it to swap their stable coins into hype or something else. But, I think it's also showing the landscape of how our customers are changing. One of our customers, Ramp, is powering stablecoin business banking accounts. They had a company, a Y Combinator company that recently received all of their funding all in stablecoins. So, I think definitely I truly believe that we're at the inflection point, especially from a B2B standpoint. I think from a retail standpoint, which is why I'm really excited about working with Stripe and Bridge, is that there are easy card integrations that you can tie to a wallet balance and spend and enable just-in-time spending directly from a wallet. And so I think as those integrate into traditional card rails where Visa and MasterCard are accepted today, that also makes consumer adoption a lot easier. And I'm hopeful, and I do think that we're going to see more of that over the next year.
I love the fact that you brought up card.
$10 for a large, $10 for any 3 toppings, $10 for your choice of hut crust, only at Pizza Hut.
Smart founders know something most people miss. Get your domain name even if you're not ready to launch your business.
Stay tuned for an exciting announcement later on that, associated with SWE Dollar as well. Ben, do you have anything else to add on top of that?
I just say I agree. Yeah, I mean, I think it's dominated by trading. That's what most things happening on chain are, right? A lot of the automations on chain are, DEX trading and optimizing around things like, pumped up fund and things like that. But you are seeing like Visa comes out in every single earnings report talking about how much they're settling in stablecoins, right? And every quarter it gets egregiously larger at every turn. And so I think really internationally outside the US, you're seeing that tick up of people saying, I want to hold $1, right? I want to save in $1 and I don't want to convert it into the absolute last minute when I spend it. And so like you're seeing a lot of those card transactions move into stable coins, and I think the B2B transactions as well. And you were starting to see a lot more platforms taking a more payments focused approach to stable coins and how they're expanding. Like something that you and I have talked a lot about and expanding $2. Like I think over the next year, you will start to see like real use cases coming out of like, hey, this makes our business more efficient, right? This makes our users happier, right? We have a customer in Africa that had moved their entire card product from dollars to stable coins. And the primary reason was because their reserve account, if they had an excessive amount of spending over the weekend, they had to freeze their card product because they couldn't top up their reserve account with Swift over the weekend. But now that they're on stable coins, like their product just works better because they can set up automatic alerts. If it goes below X, they top it up in stable coins 24/7, 365. And so like they've been able to expand this product materially within the first couple of months of like what they already had just because it's on stable coins. I think it's expanding rapidly as people are just finding the use cases, like the small wins with stable coins that just change how their business run.
I love that you brought up Africa because we've invited an exciting partner, an exciting company based out of Nigeria, Paga, who will be speaking about how stablecoins will unlock African payments. So hopefully you guys can stick around for that. I'm personally super excited for that session. So then, in terms of stablecoins being the default for settlement, what needs to happen for that? Because to me, it's a no-brainer. Why aren't more companies working with you in settling their cross-border payments, their merchant crypto pay-ins and payouts via Stripe, Bridge, and Privy?
I think like the first step of what you asked earlier is like the regulatory clarity was a big step, right? A lot of these companies are like, how do I account for a stablecoin on my balance sheet? What does that mean? And they needed to take those baby steps to get comfortable. And like we're nearing that point where that bar has been crossed. And then it becomes, is the cost actually better? Is the speed actually better? And so in countries, like if you're going from dollars to euros, that is a well-trodden path, right? Stablecoins don't add a ton of value there. But when you're going into Naira or pesos, right? Or a lot of these other currencies going bidirectionally, it's cheaper sometimes to go through stablecoins, but it's materially faster. Like we had one company, a decently well-known space-related company that was shipping product into Brazil, and they didn't want to hold reais until the absolute last minute. And so they called me on a Friday afternoon and said, I have a ship pulling into port right now, and I need to get $3 million into Brazil. Can we do that? And it took us 37 minutes from that phone call to money in their account because it took 30 minutes for the wire to land at Bridge, right? And then we got into stablecoins, traded it into VRL, got it to their account via PIX. And so we're starting to see that efficiency really pick up, but it's just going to be slow moving of people getting comfortable with this new rail, these new counterparties on the FX side, on the stablecoin side, and kind of slowly snowball into it just happening under the hood.
Yeah, I think I'll add to that too, and that I think we've made big strides over the past few years. I don't want to discount all of the progress that's been made, but I think on and off ramps, I think especially in different markets, is particularly challenging. And again, part of it is for regulatory reasons, part of it is for liquidity reasons. I also sit here as a Singaporean, knowing that most of stablecoins today are like dollar denominated, and for a lot of countries that makes sense because they have like currencies are not as stable and they do want to hold on to dollar access. Coming from Singapore, where the Singapore dollar is basically managed by the Monetary Authority of Singapore within a kind of like narrow peg with the US dollars, that to me like matters a little less, right? Like I'm navigating something about 1.34 to 1.36 like exchange rate at any one given time. And so like I can imagine if I were a business in Singapore, like I would want the ability to be able to off ramp and settle in Singapore dollars as opposed to holding on to these stable coins. So not to say that that businesses there aren't exploring it. I think they're leaning into it. But I think I think we're really talking about that future state where everything is on stable coins and we never really have to off ramp anymore. There are a lot of local market considerations to be mindful of as well.
I fully agree. For me, the main pain point are the ramps, and in particular off ramps, the last mile. So I do think if we're able to unblock that, hopefully we'll be able to see more real world economy stablecoin settlement activity. So then for that, maybe the last question for you all. If you had to make a prediction for 2026, I have to do it, it's obligatory. What would your prediction be as it relates to stablecoins activity? It can be volume driven, it can be surprises. I want you to be contrarian. Who do you think is going to issue a stablecoin in the US? Give me a name and let's go to market with them together.
I'm hunting this question over.
I don't think I can give you a name. I've signed my life away in NDAs, but I think you will see multiple enterprises, like big wow names, saying kind of like when Stripe.
Olivier, for taking the time to talk to me. For those who don't know, Olivier has over 30 years of experience in finance, particularly in analyzing the financial markets, and most notably, you worked over 6 years at Swift, and you're now leading DLT, or Distributed Ledger Technology, senior business analyst at Euroclear, which is one of the largest SCDs, if I'm not correct. CSD, sorry, yeah, Central Securities Depository in Europe.
Yeah.
A lot of these names and terms not easy to pronounce, but yeah, I don't think it's you need me to say that it's a very impressive resume, so I'm very excited to get into it. Yeah, to start off, Olivier, could you talk to me a bit more about your background and your role as a senior business analyst at Euroclear?
Okay, I started working in a CSD, in the local CSD in Belgium 30 years ago. Next week it will be 30 years ago. And I was always from between the IT and the business, starting from IT side. I've got an IT background. Even I learned IT, even Java exists, so just to give you an idea of my age. And with time, I was trained on different financial specific things. So I learned more and more about finance, and I moved to more product management type of role. 10 years ago, I created my own company around blockchain. We were probably a bit too early at that time, but it was quite fun. The company was rather sustainable because at the beginning it was quite difficult, but at the end we made about a dozen of proof of concepts. And I was part of the BNP Paribas digital asset group for building the BNP Paribas group strategy on digital assets. That was quite fun. And after COVID, a lot of things has changed. And I went back to an employee role at Euroclear because they were looking for someone who had DLT knowledge and a CSD knowledge. So there are not thousands in Belgium, so I was lucky they found me. And I joined 2.5 years now ago. Yes, something like that, 2-3 years ago. And my role is really on the IT side to be the referent person when it comes to DLT, everything related to DLT, more on the functional point of view, because there is another guy who is more technical, with the technical architect on DLT. But the two of us, we do the kind of center of expertise, even if it's informal, regarding DLT in the group for the Euroclear group.
So you're with you and the other person are the only people working on DLT within?
No, we have more than that.
Okay.
We have different projects in the group on DLT. Some projects are more, how do I say it? We are more involved to learn and listen, and it's like the Chainlink project. I saw on your questions the Chainlink project with Swift. That was typically the kind of things other people did with. Well, I was involved, but there were other people. We also have our own solution. You may have seen press releases on a system called DFMI, so the digital financial market infrastructure. This one is built on Corda, so it's a DLT, and we have a team working on it for maintenance, evolution. We support more. We try to support more business. We're involved in the ECB experimentation on digital cash. So we have quite a large team, large compared to a startup, small for a big bank.
Yeah.
But we have a dynamic team working on DLT.
That's great. And how did you get originally involved in blockchain? And like, when was the first time that you got in touch with blockchain, Web3, and DLT?
Oh, that's a long time ago. I heard about Bitcoin, and I thought, what's that? Because I'm very curious, I tried to understand it. It was probably 2013, something like that.
Wow. That's early.
And I thought I will buy a training on that to understand. And for the same amount at that time, I had the possibility to buy 10 Bitcoin. So the Bitcoin was at, I don't remember, 120 or something like that. So I bought 5 or 6, something like that.
Wow.
And I exchange it between different wallets that I created on different exchange. I do some FX transaction because I had an account at Itbit in Singapore dollar and one in France at Premium. So I made foreign exchange. I even pay, that's annoying story, but I pay a meetup in Singapore next to the Cybers event using my Bitcoin. And this meetup was something like $80, something like that. But I paid with 0.3 Bitcoin at that time.
Oh, wow.
So it was probably the most expensive meetup I never attended. But all in all, I spent so many Bitcoins to just play, learn, etc. that I ended up with only one. Because as a good banker, when Bitcoin reached 400, I thought, wow, ×3. So I said, okay, that's how I learned. But what was very interesting is the technology behind. And I thought the technology can solve a lot of problems that I had before in my professional life. And I proposed it to my boss at that time, but the company was being purchased by another company. So he encouraged me to create my own and do some consultancy, what I did in 2014, so 10 years ago. And that was cool. So we developed with another guy. We were two. CTO was an Ethereum expert. We made a dozen of proof of concept. One of them was a marketplace in the Netherlands for kind of long-term loans between institutions. It was quite interesting. We made it on Ethereum, not on the live network, on Robston, I think at that time. I did program a little bit, but I was more on the functional part. Accepted that we tried to create an investment fund during COVID to get busy. The idea was to have an AI engine to decide how to balance portfolio on ESG products and tokenizing the fund in very small parts and distributing the fund in a tokenized form. And then we had to discuss it with the regulator. And after discussing with the Belgian and Luxembourgish regulators and the French one, we realized either we move to Singapore, Hong Kong, or Delaware, or we just do something different. Because I saw another question about regulation. Regulation in Europe, it's really a hurdle or a barrier to adoption of this technology. That's really the main concern we have today with DLT. That's why I told you I don't see any successful project on DLT in a bank, because we have so many regulation impacting us that having a true DLT project is almost impossible.
Yeah. We recently got recently we got the introduction of the MiCA regulations in Europe. Do you believe that hinders the process of blockchain adoption in general in Europe as well? And will that give an advantage to other continents or other?
No, absolutely not. No, it's good to have a regulation, but we regulate everything. Even when you go to the toilet, we need a regulation in Europe. that's painful. MiCA is really focusing on cash, because one of the statements in MiCA is if there is another regulation regulating it, that's the other regulation that takes it, more or less. I keep it simple. So in the financial markets, with security token, as we call it, it's so difficult because we are, from a CSD, we are under CSDR. All participants, they have all the regulation about the fact that they are custodian, and if they want to distribute it, they have regulation like PRIPS or MiFID that are impacting it. So it's MiCA will help for the cash leg, but the cash leg, it's interesting, but you see today that there is a battle between the CBDC for central banks who doesn't want to lose control on the money, and you have some banks launching the tokenized deposit or something like that, whatever the name is. It's like a deposit token where you have your token is backed by a real asset on an account. But if you put cash on an account, it costs money just to manage it. So what's the point? CBDC, I don't see any value on it. For the retail, I think it's stupid. For the wholesales, why not? But as long as you don't have interoperability between CBDCs, why not using correspondent banking or the traditional channel? I mean, if you have a digital euro and digital pound, and you make a transfer in a UK security in euro, one day or another, you have to convert your euro in pounds. So the point would be to do a transfer from your own euro account to your client who might be in pounds. But you cannot do it with CBDC.
No.
Because both parties have to be on the same currency. That's a real issue. If you don't propose automated forex regulated by central banks, like an automated market maker, for example, like this kind of technology that we had both on DeFi and on some new emerging banks like Wise or others. If you don't have it between central banks, I don't see a lot of values today.
Yeah, I was gonna bring up a next question. You already pointed out with the CBDCs. We recently saw a lot of market turmoil with the Bank of Japan's interest rate hike, and it caused like a chain of effects throughout the global markets. Do you believe that whether it be a CBDC or alternative DLT blockchain solutions, that could be helping managing such volatilities? Because again, all these markets are connected to each other. That's why you had something in Japan or China happening, it has effects on Japan, and that also has effects on America and all the other currencies around the world. Do you believe that could be a solution, blockchain or?
No, I don't think it will change anything. You have to see it differently. From a global trade perspective, or let's say wholesale CBDC area, now the market is moving. The market is reacting to any change, whatever the technology of the currency is. So for the market, if there is something happening in China, it will affect the whole market, with or without CBDC. From a personal perspective, it's a little bit different, because if you take the example of the guy in Venezuela, or is receiving his salary, is buying Bitcoin at the beginning of the month, and at the end of the month, even if Bitcoin is fluctuating, he still have more than in regular Venezuelan. So you can imagine that some of the digital currencies will become a kind of safer value for these kind of people. And if they are not subject too much to market change, it might help people in the world to save a bit of their money without being affected by the collateral impact of big crisis on their own local money. But we saw that Bitcoin has a bit of it went down after the big crash. So it's still a bit correlated, and we need more correlation between Bitcoin and the global markets.
Yeah, it's funny that Bitcoin is created as we could say a hedge against the traditional financial system, or more as Bitcoin got created as a reaction to the 2008 financial crisis, and eventually the ultimate goal is to replace the dollar or any other currencies as a decentralized currency. But yet in the DeFi world or in crypto, we're celebrating when an ETF, a Bitcoin ETF gets launched, but that's just, we're still very much tied to what's happening in the traditional financial world. And we shouldn't actually be celebrating that we got a Bitcoin ETF, because we just participate in the traditional finance system. And it shows that, yeah, we're still very much tied to well, I'm not sure if I could say the old ways, but you know what I mean.
Yeah, I found it rather ironic.
Yeah, exactly.
To see that after Bitcoin, we created the same thing that exists in traditional financial market. DeFi, what is DeFi? Basically, it's financial markets, old-fashioned financial markets. We lend, we borrow, we exchange. No, we do derivatives.
Yeah, you're right. But yeah, I guess that way is needed to get to that goal, I guess. I'm not sure if Bitcoin eventually will be the end goal and will be the major payment system of the world. If not Bitcoin, it could be something else. But one thing I personally believe in is that blockchain will definitely, blockchain is definitely here to stay. And to that point, I also want to ask you a follow-up question to the previous one. Do you believe that what's happening in the markets, you could, whether that's on the financial side, but I guess also, well, on the social side in the world, you have a lot of things going on, you have wars or looming wars, all of that. Do you think that these conditions accelerate the need for blockchain and crypto technology adoption in the banking sector?
That's a good question. I don't know. I've got the feeling, but it's probably because I'm old and grumpy sometimes, but I've got the feeling that most of the people don't realize that, firstly, they let too much power to the regulator with their own money. They spend the whole life working to save money for the retirement, and they let the state decide for them. So they don't realize it. And on the other hand, they just accept it. And they don't realize that technology like Bitcoin or any other technology or any other currency using the technology like blockchain can be an alternative way of managing their own right to get money. I think people don't get it. And if you look at some of the crises, they say, yeah, okay, no choice. But no, you have a choice. You don't know, but you have a choice. And when you explain to people what Bitcoin is, they say, yeah, that's for terrorism, that's for ransom, that's shitty thing. You can buy drug, you can buy, the reputation was not that good. And I think banks and regulator are not in favor of Bitcoin, because you probably have more people who understand the impact of Bitcoin in banks than in population. And because they understand it, they have to save their life for longer. As long as Bitcoin is seen as a very negative thing, they will continue doing the work as they did before. You have to know that a bank is like a huge ship or a huge container ship. It will move, but it will take years and years. So the banking sector, helped by the regulator, they need to gain time to adapt. And today, the regulation will put barriers or hurdles to the adoption of crypto technologies or crypto assets or cryptocurrencies. At the same time, they have the negative impact or the negative perception of this. Like that, they can get some time. They're trying CBDC to see, okay, do we understand it? Can we try to have an alternative? But CBDC, none of the bank is interested in retail CBDC. That's a big problem.
Do you think retail CBDC is tied to, corporate CBDC, if that's what you can call it?
To me, it's two different things. If you buy a security, if you take the traditional way, big custodian is exchanging securities with another big custodian. They're changing it in a local market against central bank money. So I give you 1 billion of shares or bond, and you give me 1 billion of money with central bank account movement. So the price of your money is 1, because €1 in central bank is €1 in central bank. If you go to retail, if we are in the same bank, if I buy €1,000 of debt that you give me, so it's an internal to the bank, the €1,000 is from your account to my account. But what is the price for a bank of this €1,000? Because today the price of money on a bank account is about 1 to 10. So for €1,000 exchange between us in central bank, you can have a collateral impact of 100. So all sales is 1-to-1, but retail, we're talking about something different. If we start doing retail payments using central bank money, it will cost a fortune to retail banks, because you need much more money in central bank, you need much more deposit, and the banks, they simply don't have it. So on one end, we push to have, with Basel, we push to have 30, 20, 10% of the money in real cash in central bank. And on the other end, we would say, okay, now every single payment you do should be in central bank. That's simply unavoidable. You can have it. So what's the point of a bank proposing central bank money payment to retail people? That makes no sense.
Yeah, you're right. It definitely, yeah, you need a big reserve as a bank to be able to handle that, well, liquidity, that volume. You mentioned before Euroclear, obviously. You were a keynote speaker at Chainlink SmartCon in 2023, last year. I watched your panel. You were there with other industry leaders from Swift and ZBank. SDX was there too, and of course, Sergey Nazarov, the co-founder of Chainlink. And you talked about how on-chain finance is transforming global markets. Since that point, how has the conversation around DLT and blockchain evolved within Euroclear?
Well, Euroclear, first of all, you have to know that Euroclear is a systemic company. Mm-hmm. So we manage, in Europe, we are the most important infrastructure for exchanging bonds, equities, and funds. You have to see it as a central bank for securities. So we are very regulated, very secure. You can see us as a big infrastructure company that is 99.99 available in the most secure way. That's how we see it. So explaining that will give you an idea why we're not the most innovator. That makes sense. So we are more following what others are doing. However, we realized that having a DLT approach and having, for example, bonds. Why bonds? Because it's easier than equities. But having bonds, digital bonds on our own blockchain, our own DLT, will be rather interesting for the future, not for now. Today, that's no value, but in the future, you can see it in a more longer term, and say, okay, we have today some siloed infrastructure, very secure. Some people are now open system, others are mainframe, and etc. And we don't really communicate, except it we're using Swift. Swift message is nice, but it's asynchronous message using communication, like I send an instruction, it happens or not, I get transaction summary. So it's quite easy, but it's not the most efficient. Mm-hmm. So you can imagine that the largest CSDs are connecting together using real-time infrastructures. And these real-time infrastructures are open to similar blockchain from the participant. So me as a client of, let's say, BNP, and you as a client of, let's say, ING, mm-hmm. we could potentially trade together on a retail perspective without going through the whole process at the bank and filling paper, etc. To say, okay, we do the deal, we use something fancy like HTLC because it's the buzzword of the month. We use something like that, and the trusted authority at the end of the day will be Euroclear, because that's the end party will settle the movement of trades because we're not in the same bank. So you can imagine that. But this is compared to what we have today. That's science fiction because we need interoperability between the different networks. And that's why Chainlink is interesting. And I think Sergey understood it. And we need the regulation to allow it. And today, this is absolutely not the case.
That Europe is hindering, or well, I guess it's in general in the world, in specific in Europe, I guess MiCA and other regulations are hindering that process of making that happen.
It's not MiCA. MiCA is trying to solve it. But if you look at what we do, the regulation is CSDR. So the CSD regulation. And the CSD regulation was made to ensure that the major CSDs are acting like market infrastructure, like central banks, the same level of security and control on central bank. So I will give you an example that the regulation imposed. If two clients with a node, so you have ING with a node, BNP with a node, they trade together, they exchange something together, the CSD has to be involved in a transaction and should be able to modify the data of the trader. So if you think in a blockchain philosophy, it means that if ING is using the private key to sign a transaction to BNP and vice versa, the CSD should be able to modify something he didn't sign. And that's the regulation. So, and the regulation will come to different level of holding. The custodian has to be able to correct the balance. If you make a transfer and you realize that you have additional fees that were not taken into account, the bank will debit you without your authorization of the additional fees. It's not you who will say, okay, I pay €2.50 more. You will be debited with no choice because the regulation imposed to each bank to be able to adapt balance of the client based on whatever circumstances. It can be legal, it can be fees, it can be a lot of things. It's exactly the same thing. So in the blockchain philosophy, if a bank is providing a blockchain to the market, the bank should be able to modify transaction or to add transaction on behalf of participant. It means that even if I have only one private key on my account, the bank should be able to manipulate my account. If I can make a parallel between normal accounting and the distributed accounting. And that's a big problem. That's why most of the banks, they're using technology like Corda or Hyperledger and not a fork of Bitcoin. Because if you install an Ethereum, a pure Ethereum, you will not be able to do that. Of course, you don't have the private key. Of course, you kicked out. But on Corda, Hyperledger, or even the version like Bezu and some of these versions, you can do it.
Do you know if the question that popped into my mind? Do you know if Bitcoin is considered a security here in Europe?
Bitcoin, no, I mentioned Bitcoin, but if you look at all the discussion we have about public blockchains, everybody is talking about Ethereum. We see a bit of discussion on Avalanche. No.
Avalanche, okay, interesting.
Avalanche is becoming more present, I think marketing at least. There's some proof of concept with Avalanche, in fact. But most of them are on Ethereum, some on Avalanche. I think that's no. There is one in Europe with a Polygon. Also.
Polygon. I was about to, yeah.
Polygon. Yes.
Oh, that's interesting. And well, with all the interoperability going on or working on, well, going back to Chainlink actually, which is a decentralized Oracle network, they have a partnership with Swift to explore blockchain tech and how it can be integrated into TradFi systems. How is that currently going? How is Swift? Because you work at Swift, is there any progress being made in blockchain technology and cross interoperability systems being implemented within the, I guess, messaging network that Swift is.
Yes, I heard positive things about it, but you have to see Swift as a set of different networks.
Okay.
They propose different access. You have the traditional Swift, who was a traditional X25 network a long time ago, where you send a message and you hope the other one will get it in the 2 days. It's still on, but they changed the technology. But it was too slow, so they were pushed to have something fast, something on IP and not X25, and they created what they called SwiftNet. They migrated the former X25 network called Fin on IP. So they have they still have the two service on top of a single network layer. And now there is the blockchain. And the big question is to do what? So today, is there something that you can do on blockchain that you cannot do on traditional Swift? That was the key question. And the key question was answered by no, not really, accepted the actual movement on the blockchain. Because if I send you a Swift message to say, give me your digital asset from your Avalanche to my Ethereum, I can do it. They change the standard, they have fields, they have keywords, it can be done. So I send it to you and you say, okay, and so what? So the idea that they have with Chainlink is to say, I send it to Swift. It's never peer-to-peer, it's always via a Swift hub. So the Swift hub, before delivering it to you, will ask Chainlink to do the actual blockchain movement of asset. So that's the point, and Swift is experiencing it, but they never went that far in the automation of a transaction.
Do you believe that peer-to-peer can happen one day, or that Swift could be replaced by a fully decentralized system at one point in the future, or is it just too important to banks?
Conceptually, yes, they can, but the advantage of Swift is you have one interface and you send the whole traffic, and they decide if the counterparty can receive it, how to send it, in which format. You don't have to care about. And the price has gone down, so really the value for money is quite good.
Okay.
So replacing it by a peer-to-peer technology, because today it's very nice. We have, imagine we decide to exchange things. How are we doing the trading? How are we doing the settlement? So we can do it over, let's say, over Teams. We agree, but then I send you money and you send me the security. But in which format? If I have to integrate with my own system and you with your own system, how do you expect the format to come? So you need a kind of interface. You need the smart contract to be able to handle the business information that you send. And that's something I always said to Swift. You look at technology, but you forget to look at the business standard. And I say it on the panel, because today we have a smart contract. Okay, but can I send an ISO 20022 message to a smart contract? Today, no, but we should. I mean, an ERC20, we know how to send it, but is it enough for cash? Potentially. Can I interface an ERC20 with my own system?
That's why.
Potentially.
Yeah.
Potentially, but if you compare ERC20 with the traditional MT103, that is the pure basic payment message from Swift, you have more fields on Swift than on the ERC20. So what are you doing with the charges? Who is paying the charges? And these kind of things. Value date, something stupid. You have a payment and you need the value date the day after. And you say, okay, or the day before. I send you a message today with value date yesterday. How do you reflect it in ERC20? So we need a business standard, and payment is easy. I don't even talk about securities. But we need a business standard to say any single smart contract should be able to handle this standard. And I think Swift could be the kind of auditor or validator of the business standard implemented on smart contract.
Yeah.
So if HSBC and BNP are launching a smart contract to do peer-to-peer payments, that possible? I mean, it's from your account to another account. Which one will you choose? How do you know which one to choose? You don't have a kind of reference data. You don't have a list of services. It's becoming very, very complicated. If you continue sending one Swift message to say transfer 25 Ether from you to me, and if it works, well, that's good. And that's what they want to achieve, I think.
Yeah, I mean,
that would be great.
Yeah, and I think Chainlink is a great partner in that to help assist that communication. As a going back a bit, as a senior business analyst at Euroclear with an obvious passion for Web3, what are you the most excited about in the coming 5 to 10 years?
Preparing my retirement. So, no, but we have quite interesting projects going on. I mean, the system we have built is for primary issuance because the client asked us to link it with the legacy system, because the legacy system has thousands of clients. So it shows that adoption needs reach. We need reach. And I think finding the way of growing the reach is something hyper exciting. How can we convince people to adopt our system? That would be very, very interesting. I don't have the answer today, but that's very exciting. Supporting new products. I don't know.
You're in a world where everything is changing so fast, and at the same time, it's not, because you have traditional finance and they like to stay within the safety of the system that they build. But at the other hand, well, in some regards, of course, but it's a very volatile world. I'll say it like that. So new things coming out every single day, and it's very exciting to see where we're going. I have 1 or 2 more questions, macroeconomics wise, just because you're a business analyst. I'd love to get your personal opinion on this. Again, there's so much happening. It's election year. We have the Fed and the CBE. They might suggest or they might cut interest rates, perhaps in Europe, or definitely in the United States. They will turn the money printers back on. What's your analysis of this? Do you think the world is heading towards a recession, or?
That's a good question.
It's a complicated question.
It's a good question. I have absolutely no idea. If I listen on the radio a couple of days ago, I heard a very famous analyst, business analyst or financial analyst, and he had the same question. Do you think the result of the American election will put the whole world in a recession or something like that? And he said no one can predict it. So
there's a big shift definitely happening from the west to the east right now. I think I definitely agree. All eyes are on America. In this day, I think America still is the #1 economy in the world, but we forget that Asia is there. Sometimes we forget that there's China and there's Russia, where we're also doing things, and we're so focused on what the Fed is trying to decide. But then, you have the BRICS countries too that doing their own things. And yesterday, for example, Russia legalized crypto mining again, which is, I believe, a very big shift again in how Asia is looking at cryptocurrencies and blockchain with their own goals. So I believe that in again 5 to 10 years we will see a major shift, and who knows, maybe in 10 years we'll be talking about China instead of the Federal Reserve or the China Central Bank there, or the Bank of China.
Yeah, but that's something very important, because recession might happen, of course. Economy in China is not going very well now, but you said 10 years, 5 years to 10 years. What will be the business partner of the European banks in 5 years? That might be the key to understand it. And keep in mind that the first CBDC that works is in China, or Salvador, or whatever. But I prefer talking about China. It's more impactful than Salvador. So I think if China decide that wholesale CBDC is a very good thing for global trade, and if they open it, make it easy, and have a reach, because they might have a reach, we will have to think of CBDC, but in terms of digital yuan, more than any other one. The digital euro, I think they have lost the war of CBDC because they're thinking way too much on a market that is already automated. We have already a lot of digitalized cash. We all have our credit card, we all have debit cards, we all have payment by mobile, etc. While in a different, on China, they move from paper to distributed directly. So that might be a key changer, and more than what the US is doing for the next years.
Yeah, they're stepping away from the dollar as well, Russia and Asia and BRICS. So very interesting to see what's going to happen there. I think I have all my questions asked. Thank you so much for taking the time to talk to me. Are there any upcoming events or updates from you that the public should know about? Maybe some exciting stuff that's currently happening at Euroclear. You mentioned something before.
Well, we will publish a white paper October, something like that, on interoperability, because we made a gateway to make our DFMI system interoperable with other systems. But it's more lab research, because today we're discussing with half a dozen of other network providers like the HSBC, DTCC, etc. But none of them want direct connectivity between networks. It's more via Swift message, for example, or other type of message. So, but it might be interesting to see the market reaction to our white paper, because basically, well, it's white paper, so we don't say a lot. But what we said is, okay, we linked an Ethereum, a Bezu system to our DFMI that is Corda. So we said, okay, we need security to know which account can have which security. But this is not the point. It's quite easy to do it. We made it, test it, it's cool. What is really important is what you do with the reference data, because the reference data are on our own system. And if I send you a token, because we use ERC20 type of token, with a reference to a reference data that is formalized in an NFT type of things. So we say, okay, my ERC20, I've got 20 equities of whatever. I point to an NFT that is the reference data. But if I move the token to the other network, should I move the NFT with it? If I make an update on my reference data, how can I update all the NFT that move to different networks? That was really the key question. And if I use traditional way to publish information, how can I make sure that the problem we have today are solved? And they will not be solved, because the problem we have today is the update are not taken into account by all the web servers in the world. So if you look at 2 or 3 or 5 different data providers, you might have different data. So how can you solve it with the blockchain? Are oracles the best way to do it? I was thinking of Chainlink actually to do that. Can I publish using Chainlink the data that are the golden source on our Corda system, publish it via Chainlink, and any network in the world can subscribe to it?
That would be great.
But, yeah, but there are so many constraints to that, and so many legal stuff that it will take years. But I still believe that should be the best way forward. But
well, that was super interesting. I'm definitely, if it's out, I'm going to check out the website. I'm very curious to read it. Thank you so much, Olivier, for taking the time.
Yeah, enjoy Hong Kong. Is it Hong Kong now, the Chainlink event?
Next SmartCon is in Hong Kong, October